Hello everybody, welcome to TraderMerlin Show. It is your Monday edition. Sorry I missed on Friday, everybody, but unfortunately going forward, there'll be a bunch of days I'm going to miss. For example, tomorrow I have a meeting I cannot get out of, but I'm going to do my best to do this show. I may end up ultimately moving the time to accommodate more work schedule, but I got a nice promotion and I've been dealing with a lot more, just say, responsibility with creation of content. So I'm going to be pretty damn busy, but I'm going to do my best effort to keep the show going as long as possible, hopefully forever, right? Anyway, shout out to everybody that's joining us today. Alex Mukas, good to have you with us. Hopefully the games are going good. I saw the Rangers did a number on you for 3 games, but good to have you with us. And by the way, Herbert, we have a strange city out here in California called Zzyzx. It's ZZYZZX is the name of the town. If you live in a town called ZWZWZW, I'm impressed. I want to get an address in that town just to mess with people. Anyway, hope you all had a great weekend. It was a beautiful one out here in California. Les, Tom, Daryl, Ivzy, Lori, Thomasina, Terry, Tom as well. And Tom, thanks for the email. Congrats on that one. I think that Online Trading Academy did you a nice favor right there. Good to have everybody with us. It should be an interesting show today. I'm going to try to keep it on a technical perspective. We'll be looking at stochastics versus RSI. This is a question that came in from a viewer asking which I prefer, and for those of you who know me, you know I really don't prefer either one. I'm not a huge fan of technical indicators, period. However, there are some things you should know as you're using these ones, so we'll look at that, and of course, go to whatever listener questions you guys have. So, if you do have some, feel free to send those questions on in. For those who might be new, you can hit that subscribe button that's on the home page there or on the screen. You can also type in questions by doing like a 3 or 4 question marks before your question in the chat, just so I know what's directed at me, because a lot of times conversations get very, very active in the chat room. All right. Yeah, I got promoted. I'm a senior director of content production. Ooh, pat myself on the back. Whatever. I just love making content. Harrison, great question. I don't trade the micros. If 21,000 traded on that Bitcoin futures contract, the micro, no surprise, right? You're in a period right now where a lot of people have kind of split ways, and part of the group is saying that Bitcoin's going to go to zero and disappear. The other group saying this is just a retracement of a natural up move, and therefore we should see some more upside move here again in all-time highs. And I'm in the latter of those two. Now, with regard to a $21,000 print, sure, could Bitcoin hit 21 grand? Yeah, absolutely. I mean, let's take a look at the price chart. I'll look at the full Bitcoin contract as opposed to just the micro. You get a little more view and history when you look at this contract. So 21,000, that is a logical spot, right? It's way down here, right where my line is, right after the origin of that gap. So it gapped up at 21,000 and pretty much has not filled that gap yet. There's also another gap that I think you'll probably, that would be more tantalizing as a fill around 25,000. But, a lot of times when the volatility spikes, people take these kind of high flyer bets to protect themselves, maybe hedge a position, and also to maybe capitalize on it. So who knows which way this thing's going to go. I don't think that you'll see it get down below 30. I think that we've bottomed. I think that is a short-term, bottom there, and we'll ultimately see this thing rally back up. Today's looking pretty good right now at about 39,000. Perfect. Okay. I'm not going to keep bashing technical indicators, Tony. I don't bash them. Look, I think that I've said this many times in the program. I don't care what you use. I'll hold this up, and this is where I'm going to use my potty mouth. This is a dog poop bag. I get to go to the dog park, right? I use these every day for my German Shepherd. If you're using dog poop bags to make your trades and you're finding that you're winning all the time, then I don't care. Use dog poop bags to make trades. It makes no difference to me. It's just a lot of people, what they do is they put too much emphasis on the utility of an indicator and put their emphasis of the entire trade on that. And to me, that's where the problem arises. So I will go over these indicators right now. So let me go back to, and by the way, we will go through the top markets. I'm going to bring that back here on the show today. So we'll go through the top 7, but I'll do that near the end and then open up to any Q&A. But I want to get through this question, which was RSI and stochastics. Now, of course, we're still doing our challenge. I actually have makeup to do since I didn't do my 100 yesterday. I keep forgetting, and I have to do double days. It's terrible. All right. So Lee says, with RSI or stochastics, what's the best way to use them? Do you have a preference? Yes, I absolutely have a preference. Now, as I just mentioned, the important thing to understand with indicators is they are absolutely not the answer. They are a supporting piece of information which may help you make a decision, but you should never be trading exclusively off these. Some of you might remember years ago, there were these red light, green light trading systems, right? Oh, you just buy the software. When you get 3 green lights, you just buy and you just make money miraculously. All those were technical indicators like RSI, like moving averages, like MACD, put behind a little piece of computer code that you couldn't tell, combined with some volume, and they would just flash lights on when the indicators told them to flash the lights. Unfortunately, those work great in a specific type of market. For example, moving averages. They work fantastic in a trending environment. If we get a market like kind of has been with Bitcoin for the past few months where it's had this kind of choppy back and forth, not really the best, right? It's not going to give you the greatest signals. So when you go to these webinars or seminars that you used to have for, I think Wise Trader is one of the big ones, what they would do is they would have shills in the crowd and they said, oh, would anybody like to see this on their favorite stock? And me. And what symbol? Oh, could you look at it on Apple? Boom, bring it up. Oh, Apple would have made you, $7,000 in one day if you just use our software. It's all cherry picked. It's planned. They'll ask the questions of stocks that are trending very strong to support their software. So that little rant out of the way, let me go to some price charts here, and I have a couple of these indicators set up already on the screen, so we'll do the best we can on this one. I got too many lines on this bad boy. Let's go to the S&P. Gosh, I got lines on everything. Markings all over the place. All right, let me get rid of some of this stuff here that we have on the NQ so we can do it there, or maybe we'll just go to the triple Qs. So here's your NASDAQ 100, okay? NASDAQ 100 ETF. Now, if we take a peek at the price action of this one, I'm going to disable all indicators here because this is what you should be doing. Do not start with an indicator. Start with price. Now, if you look at what's happening right now with the Qs, we've had, 3 out of 4 days have been great up moves. Currently at 332.51, we're coming right into an area of supply on the Qs. So, with that in mind, we can already start to formulate a bias of what we'd want to do. For example, if the NASDAQ has been trending down for the past month and now we're getting a bounce back up into a supply zone, it's probably better to look for a shorting opportunity. Why? Simply because the trend has been down since, mid to late April. Now, that's not a long-term trend. Some of you might be looking at weekly time frames and the whole chart would look very, very different. So for me, if I look at this chart, I'm looking right now for something that might be overbought. Now you can tell my trade by itself would probably be okay because I'm looking to short once it gets up into this zone. And I'll draw it out here for you. Let's say our zone is somewhere in this yellow box, the infamous yellow box, right? And I'll say the bottom of that box starts at right around 334.25, okay? So if it gets up into there, great. I'm looking at a potential short opportunity based off of price action alone. So what I could do is I could ask for validation from the indicators, meaning is RSI overbought? Is Stochastics overbought? And I'll tell you right now, if they're not overbought, they're rather close. RSI is probably a bit weaker than Stochastics. And the reason for that is just simple math behind the calculations and how these things are constructed. So let's start with the one that I think is probably going to be giving us more of an overbought indicator, and that would be Stochastics. And then we'll look at RSI in a second. So here's Stochastics. Okay, Stochastics is just now, as we speak, hitting an overbought situation. That's this little light blue line here. Now, for those of you in the crowd that don't know what Stochastics is, if you want me to explain what Stochastics is, I'm more than happy to explain Stochastics and RSI. Just sometimes I get people who are very experienced and some have very little experience. Either way, I'm happy to explain it further if you want. So if you do want me to explain it, just say, please explain Stochastics or RSI, and I'll do that for you. So as you can see, we've got these two lines. And right now, the Stochastics, this is fast Stochastics, is just crossing above 80. Above 80 is deemed to be an overbought area. So anything, let's see if I can highlight this area. Anything in yellow at the bottom, that's overbought. And anything down below is deemed to be oversold. So you got those two little yellow areas there. Okay, short explanation, let's do it. All right, well, so what you have here with both Stochastics and with RSI, they both use 14 periods of data. Now, all indicators, every one is going to be using a set of data to formulate the calculations, right? So with Stochastics and RSI, conveniently, it's 14 periods, meaning 14 bars of data. And the reason I use periods is because if you're using a daily chart, it's a 14-day window of time. If you're using a 5-minute time frame, well, it's 14 5-minute candles. So they're using 14 data input points. With stochastics, they take 14, and what they're really looking for is in that window of 14 bars, where is price in relationship to its range? Now let me see if I can do this over here. I haven't used this drawing tool. I'm going to see if I can debut it here on the show today. At least try to debut it. Let me see. Okay, all right, I've got it there. So let me see if I can bring the screen up for you. Bear with me 2 seconds as I try to draw on my screens and make this all look nice and pretty for you. Let's go to there and add in a new slide. Okay, so what I will do is I'm going to draw very quickly, if I can draw them to the best of my ability, 14 bars worth of data. So what does that look like? All right. There's your blank screen. So what I'll do is I'm going to just draw price chart. I'll draw a couple candles. So here, let's say this is one candle, right? That starts it, and then there's another 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Okay, so I know those aren't exactly candles, but it's taken me too long to draw those in. What you got to understand is that what stochastics is doing is taking this low point here, which is right there, kind of drawing it out and saying there's your low. All right, low. And then it takes the high here, and we draw that all the way over. Take your high. And it says, now that I've gone in those 14 bars worth of data and established the range, right, how far it has moved in that window of time, where is it right now? And let's say that it closed right at this low right here, okay? So if it closed there, then my stochastics is going to be there. This would be 100, this would be 0, and this looks to me like it would be right around, I don't know, 75. Well, stochastics uses a metric that says between 80 and 20, right, are our cutoffs. So based off this chart right now that I just drew, it would not be an overbought situation. Stochastics is at 75. It would be below 80 and not overbought. Okay? So all it's doing is saying where is current price in relation to the range over that X amount of data, which is why I looked at this one over here. And I kind of quickly glanced at it and said, well, where is it at regard to that 100? Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So stochastics takes into consideration all of these, right? So let me delete this yellow box, or actually move it. Stochastics is taking into this consideration that entire range right there, which I literally just drew this for you. It says, here's the high, there's the dead low. Where are we right now? It's right around, 80%. So why I like stochastics is its simplicity. It just says, what's the range for 14 periods, and where are we now? Boom. Now let me ask you all, and be really honest. If you knew that that's what stochastics was calculating, saying this window of bars, and you kind of could eyeball it on your chart, do you really need to have stochastics on your screen? I'm going to say most of you are probably saying, no, you don't need it on your screen. You can look at a price chart and go, yeah, I can see where it's at relative to the last 14 bars of data. It's overbought, it's oversold, or it's right in the middle of the range. So what I would encourage you all to do before you get so hung up on saying, I want to use stochastics, is understand in your brain how it's constructed and then use your brain to draw it visually for yourself. Meaning don't put it on your chart, use your brain to draw it. And then when you want, click the button to see where it's at. Yeah, exactly. I get more no's here. Jerry Daniel will go, no, you don't really need these things. All right. So let me go and show you, that was stochastics, and I'll go back to the chart here. That's stochastics down at the bottom. Let me disable that one. And the window up at the top, that 14 bars is going to be the exact same for RSI, right? RSI also uses the same 14 bars worth of data. But what RSI is calculating is the ratio of up moves and strength to up moves versus the number of down moves. So really all it's doing is saying, have there been more up moves versus down moves, and how big are they, right? And that's a little more complicated of a calculation. Because you can see here, there's been lots of red and green candles. To me, RSI should be right about in the middle because you can see big red, big green. Big red, big green. Big red, small red. I mean, it's pretty balanced here with regards to red candles versus green candles. Now, I know, and again, I'm glad that, Tony, I'm glad you like the visual explanation. I'm a very visual person, so it really helps me. That's how I learned it, really. It's funny because I've never seen it taught that way. I've written so many books or read so many books about technical analysis, and that's one of them. It just blows my mind how challenging they want to make it. It just simply says 14 bars worth of data, high, low, where are we right now? The DeMark sequence, don't know. Don't know that one, Steven. I mean, there's thousands of them out there. I've actually never heard of the DeMark sequence. So it's probably very similar. You know, it's kind of like, well, it's not kind of like, this industry is full of people who want to have their name on something. So what they will do is take an indicator like an RSI, tweak it just so slightly. So for example, the Merlin indicator is going to be a 15 period, not 14, because the 15th one is much more, you know, they always tweak things just a little bit to come up with new ones. I do not know what the mark sequence is. If you are a nerd like me and you kind of want to know the formula, this is the formula for RSI. RSI equals 100 minus 100 divided by 1 plus n up moves, the number of up moves versus the number of down moves. I don't know why they calculated it out that way. It's kind of an odd one. Now, as Lori says, I like RSI for momentum, not for oversold. Yes, I agree. Now, let's go back to the discussion I was talking about early on, which was with the QQQ. Right now, you have very different signals being given by these indicators, right? The number of up moves versus down moves has been rather even. Therefore, RSI, as you can see on the price chart, is right around 54. It might be hard for you guys to see at the bottom. It's right about 54.24, exact number right now. So that's not giving me any signal whether it's going to be positive, bullish, or bearish. None whatsoever. The only thing it does say is that it's been trending up, which means there's been more green candles than red candles for the past few days. Okay, so that's not going to help me make a decision. But remember, in this picture here, I would be more interested personally in taking a short position here, given the fact it looks like we're bouncing back up into a supply level around 334. So notice when I put stochastics on, how that validates my choice. All right, let me remove RSI. Well, I'll leave them both on there. RSI is the top one, stochastics is the bottom one. And you can see that now stochastics is telling me it's just become overbought. So tomorrow, let's say we get a little bit of a move up and it hits 335, stochastics is going to move up above 80, therefore confirming that this security or this market, this index, this ETF, is overbought. Now, I saw that come through here just a minute ago. Where did someone say about Bob Dunn? Tony says overbought can get more overbought, Bob Dunn. That is not a Bob Dunn quote, but he's 100% right. Overbought can lead to more overbought, and oversold can lead to more oversold. And it has to do with the power of the trend. So if I was looking at this chart here, and I'm glad you put that one in there, Tony. Thank you. If you look at this price chart here, I'm not saying I'm putting the emphasis on stochastics. I'm putting emphasis on the supply zone that's up above that we're rushing into right now. And again, I'll put that little yellow box back. All right, so there's your supply zone somewhere right in that area. If we get into that area of supply, I now feel a little bit more confident because stochastics is confirming my thoughts that it's going to be overbought. If you're not sure, if you get to that point, you're like, yeah, you know, it's overbought, I'm just not sure. Well, then you have to change your entry. And for those who are Online Trading Academy graduates, you have a variety of different entries. And the one that you would be probably looking at is waiting for confirmation, for it to leave that zone and start to drop out of that area, therefore confirming that it is in fact reversing. But never put the emphasis on those indicators. Now, I know a lot of you, and I can see that here, I'm talking about, where's Brandon Wendell when we need him? Brandon will agree with me 100% that it's not about the indicator itself, it's about price. But what Brandon likes to do is what's called positive and negative divergences, which is a little bit deeper dive into it. And I'll give you a basic one right now. Let's see. Let me remove stochastics from here. So actually, before I do that, so we're on the same page, right? Stochastics is 14 periods worth of data. So is RSI. Stochastics, a bit more simpler, says where is current price relative to that 14-bar range. So great. We can get very quick overbought or oversold signals with regards to stochastics. Now, you're going to ask, well, what's the second line here? So what they do, and I'll look at the bottom one in particular. Let me get rid of RSI. And as you can tell, I'm actually a bigger fan of stochastics. I like stochastics. I do not keep them on my charts because my brain can actually draw it without needing to have the visual on the chart. And Oh, perfect. Les actually asked that question. Merlin, what is the second trend line in stochastics? Oh, great question. So everybody wants to have a signal, right? They want to have what's the trigger? It's not necessarily because it's an overbought or oversold situation, but what's the trigger for it? That's what that second line is. And what it is a 3-period moving average of stochastics line. So remember, stochastics, which is considered %K, is the actual value of stochastics, meaning where is current price within that range. They take that and do a 3-period moving average of the %K, which comes out to be %D, and that is your signal line. It's basically looking for it to cross over. They literally just slowing it down, okay? So right now, this red line, because it's a little bit smoother, that's your signal. And what a lot of people will say is, if this isn't a downtrend, which it is since the beginning, the end of April, it's a short downtrend. I know we could look at a bigger time frame, but we'll entertain me for now. Let's assume we're trending down right now. If this thing rallies back up and gets into an overbought situation on the chart, into a supply zone, and I have my stochastics above that 80 line, now I'm feeling much more confident that this thing could turn around. And if stochastics drops below the red line, then that would be one of the triggers. Again, to me, it's lagging. It's all lagging. I don't know why people decided to use these numbers, which is a great one from Michael Nelson. Great question, Mike. He says, why 14 periods? How has this become the standard magic number? I do not know. I'm glad you call it this magic number, because there's so much weird crap that goes on, but I'm not sure why. Some people say, well, it's 2 weeks. Well, technically it means it's almost 3 weeks of trading, right? Because markets open 5 days a week in theory. So yeah, it's kind of a weird one. It's been one of those things that people have always adhered to it. And I think part of the reason is, if you go any longer, you're going to be, remember, the more data you add to it. So let's say we did stochastics of 30. Well, it's going to give us more lagging information. We have to wait longer for those trends to develop. Same thing with RSI, moving averages, MACD, all of them. The longer of a more data set you put in there, the more lagging it's going to become inherently. The shorter we go, you could be jigged out because of so much noise, right? One update all of a sudden takes you out, and then it goes right back in the direction you thought. So it's been kind of this happy medium of 14. Most indicators are using 14 bars worth of data. So bizarre. I don't know why. Now, the other piece here. So great. I'm glad, Les, glad you asked that one. RSI greater than 60 supply. No, I wouldn't use those. So basically, and correct me if I'm wrong, Believable Direction. Great name. So what you're saying is, let me go add some horizontal lines in here. We're going to make this a little bit messy. All right, so there's your 60 line. So what I'm doing in the bottom of the chart here is adding in these lines. So part of the reason that people like to use that 80-20 is because it takes time and effort to get above those, right? It means you've had a strong directional trend. If you use the 40 and 60, which are those two lines we put in here, and again, it means if it's below 40, it's oversold. If it's above 60, it's overbought. You're going to get signals all the time. I mean, it's going to jig you in and out all the time on these trades. So, part of the reason I like using the standard numbers, it's twofold. Number one, I like using the standard numbers of 80 and 20 with stochastics because of one fundamental reason. And that is because when you open up a trading platform, you log into your TradeStation, you log into your E-Trade, you log into Thinkorswim, you log into CliK, any platform, and you add on stochastics, it's 80 and 20. So the novice person, and actually just about everybody that's using stochastics, is using 80 and 20. So if we understand how the retail trader thinks, they're going to use those numbers regardless, because that's what they've been taught to do. That's in every trading textbook out there, is 80 and 20. So I don't want to tweak those too much. Is it harder to get trading signals? Yes, because getting it over 60 on RSI or on stochastics or RSI is easy. Getting to 80, now that's a much bigger challenge to get that kind of momentum and show spikes or surges in price direction. So, I'll explain Japanese clouds if you want. I can explain everything. You got to give me enough time. So that's why I keep them as the default and not modify those. Now, there was 2 points I was going to say there. It should be 10 period or 15 period. Right, Koji? If we're going to do 2 weeks or 3 weeks, I don't know. There is some magic to it. Bottom line is that's what they use, and that's what everybody's using. So I'm going to keep it that way and not modify it. But remember, if we get too short, let's say you decide I want to be first. I want to be early. I'm going to use a 7 period, right? Let's cut it in half. Well, you can create that. For example, here's our stochastics at the bottom, right? So if we do 7, you guys tell me, if I do a 7 period stochastic, what's going to happen? What is this line going to look like? All right, I'm not going to do it right now, but you guys, I will do it in a second. I'm going to give you a second to look at the price chart, and I want you to tell me. Right now, this RSI, this stochastics is a 14 period. When I adjust it, what's going to happen? What will be the signal that you're given? All right, is it going to tell you that it's overbought? Is it going to tell you that it's oversold? Is it going to tell you it's in the middle at 50? What number do you think it would be at if we switch this to a 7 period? So let's just, since I know you guys are typing in right now, due to my 30-second delay, I believe, 1 bar, 2 bar, 3, 4, 5, 6, 7. So it's going to basically tell us the range is from, I'll do the line instead. There's our range from there to there. And right now, it's sitting right at the tippy top of that range. So if I switch this to a 7 period, it's going to be overbought. And I might actually be coming down a little bit because of today's candle. We'll have to see. It may not be curling because of today's candle. But I'll go inputs and change this to a 7. And hopefully I am not mistaken. So there you go. You guys can see that it's above 80. It's at 87.09 right now. But we didn't need to do that, did we? We knew that that's what the number would be. Yeah, Alan says right around 90. Yeah, 87. Good guess. I mean, it's easy to see if you understand the math behind it. So it just simply will change the indicators and get you in and out of things faster. The shorter time frame you do, the closer overbought or oversold will be to current price because it's the most recent data. Nelson says 120. Unfortunately, you can't go to 120, Michael. It goes between 0 and 100. That's the beauty of this one. Things like CCI, that can go, well above 100. That oscillates above and below 0 if we use something like Commodity Channel Index or CCI. Okay, good. Let me put this back before I forget it and wonder why my stochastics are all off on my screen. So back to 14 periods. There you go. Okay, let me see what are some of the other questions coming in here. The channel, trading rush, backtest indicators, MACD tops, thus so far. I'm okay with MACD. The challenge again with MACD and with all these indicators is they are lagging. It's irrefutable that they're lagging information because I'm using historical data to formulate an opinion about where we're at right now. Well, that's going to be a lagging indicator. So I think you're more prepared to make better trades if you're using price action itself. So, if you guys notice for me, when I'm doing this show, I think if you look at TradeStation, I'll pick up something else I haven't marked. Let's look at Apple. You notice I don't have anything on my screen. Normally, when I show you guys charts, this is what my screen looks like. I don't have a bunch of stuff on it. I want to just make the opinions about Apple itself or whatever security I'm looking at based off of price. Now, I don't even usually have watermarks. I just left this watermark on the screen for you, the viewer, so you can see what we're looking at. If I was to add anything to this chart, you know what it would be. I'm going to go in here and disable volume. So I like volume on my charts. I think that helps me see the emotion, the euphoria or panic, fear and greed on the price chart. Right now, all looks calm for Apple. We're down below average volume, moving sideways. So this is a sit on your hands and do nothing kind of situation with Apple. Let's go look at, somebody's been asking about weed. Let's go look at MJ. Right, MJ. Volume is dropping out of this thing. We're half of normal volume. It's just trending down. I mean, as bullish as I am on the industry right now, I think you got to sidestep and move away from cannabis stocks until you get some sign that this thing's going to start to curl back up. If we were to do stochastics or RSI, notice it's been going sideways for a while. So it's not going to be overbought or oversold. It's going to be just traversing sideways. And you guys can throw any other symbols you want, and I'm happy to do some quick analysis for you. All right, what do I see? Y40 periods. Yes, Michael says oversupply or over 60 would be a lie. No, it's a lie. It's just a different way of reading it. Okay, Koja. Great question. He says, what's the difference between slow stochastics and fast stochastics? All right, you want to nerd out? Let's nerd out. Let me go and erase all the markings I did on the screen here. Actually, no. I'll do it right on the screen. All right, so bear with me as I get my studio all set up over here and go to the second screen. So Remember, we talked about this value right here, this 75, right? Oops, go back. This 75 number, right? That 75, that is what's going to be considered your percent. I don't want you to be clicking on that. Stop. Why are you? Okay, percent K, right? That's percent K. So we got percent K equals 75 in this example. Remember what they're going to do, and that line would be doing something like this, right? It's just moving along doing this, blah, 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 and starting to curl. What they do is they take a 3-period moving average of that, which is supposed to slow it down a little bit and give us crossover points. That is considered percent D. Oh, geez, Merlin. That I said D, and I actually drew the letter K. Beautiful. Let's just go percent D. Okay, so that is going to be percent D. This upper one here is percent K. So that is fast stochastics. Fast stochastics says I'm using percent K and I'm slowing it down with percent D. Now we get to slow stochastics. What you're looking at is percent D. And what they do is they take the slow version from fast stochastic, which is percent D, and they slow it down again. So what it'd be is percent D with little s. And all that is this is now a 3-period, 3EMA of that previous one, as this is a 3-period moving average, 3EMA. All right, I hope I didn't completely screw you guys, your minds up there, but that's the difference between fast and slow. Fast stochastics takes percent K, slows it down with a 3-period moving average, calls that percent D, and those are the two lines. Slow stochastic slows it down even further, and it doesn't use percent K, it uses percent D, and then slows that down with a 3-period moving average. I know, who comes up with this crap? Not me. I'm just here to show you how it works. All right, hopefully that made some sense to you guys, and you're happy with that. I've lost my mouse. This is going to be an interesting show if I can't find my cursor. Something's stuck over there. There we go. Okay. All right. Hopefully that explained it. Let me go down here a little bit. So Nahum says, I use 35 and 65. And there's nothing wrong with it. What's going to happen for Nahum is you're just going to get a lot more signals, right? You're going to make a lot more trades. For me, part of the reason that you'd want to be keeping the originals is in overbought and oversold situations, you don't want to make a lot of trades, right? Ideally, we'd like to make fewer trades, but make more quality trades, which is why I really like the example on the NASDAQ right now, because you have a nice bounce. You've been trending down for about a month. You've come right up on a supply level. That by itself is a potential short trade for me. But then you have the overbought situation with stochastics, and I'm feeling even more confident about it. So I could, potentially be looking to make more trades based off that. All right, what else do I have? Jerry says, I'll never forget 7 years ago when I walked into OTA, the student sitting next to me was a stockbroker whose whole charts were covered with indicators. Nice guy. Well, and unfortunately, that's what people, look, let's see if I got it sitting right here. There's so many books. Oh, goodness gracious, I got so many things on it. Here's a technical analysis book, right? This thing's 400 pages, 650 pages. Here's another one, technical analysis of financial markets, right? This is another one that's required readings for the CMT, Chartered Market Technician. This thing is 500 plus pages. There's hundreds and hundreds of pages about indicators after indicator after indicator. So I personally think you should not worry about the indicators. Oh, wow, I just got totally red. Look at that. I look like I got sunburned. Let's see if I do this real quick and see if I can reset this camera. Holy cow. There we go. Wow, I look red. Aiko says, my son just asked me a good question. Who created the stock market? What do you say? Okay. Well, you can tell him to look up the buttonwood tree. So in New York, I forget the years, 18-something, there was a tree called the buttonwood tree. And basically, these guys got together underneath this tree because it was shady, and they were, you've got corn? Well, sweet, I've got some hogs. Let's make some trades. So they started to make trades that way. And that started kind of the basis of centralized exchanges. The CME was written out of guys that were just sitting there wanting to trade butter and eggs. So it started off as the butter and eggs exchange. From there, obviously, there were more things that people wanted to trade, but it raised the the concept of having a centralized exchange, a location that you could go to and trade securities, whether that was shares of a publicly traded company, whether that was corn, wheat, soybeans, gold, silver, doesn't matter. That's how those exchanges were created, because one of the things that makes the stock market so amazing is it's a standardized instrument, right? I know that if I buy a share of Apple, it's a share of Apple that everybody has. It's the same instrument. Why is that? Because it's centralized. So if you ask who created it, well, it's really about supply and demand created it. Demand said these guys wanted a place to go buy and sell instruments, food at that point in time, right? At that point it was, I want some butter, you've got eggs, let's make some trades. And says, you know what, so many people are coming to make these trades, let's create an exchange and start to build that structure. So there you go, Echo. That's the basics of it. I think Mike McMahon, I may be able to find a video for you on otacademy.com. Mike McMahon did a great one on the history of the markets, and it's really good at understanding how we evolved from that buttonwood tree to the exchanges we have today, and now we're going to digital. All right. Let's see. Gretchen, so let's nerd out. No, what happened was it has this weird little pen, this tablet thing, and I guess you're not supposed to leave it sitting on there, so I couldn't find it where my mouse was because it locked it up. All right. People make it up so the name will go in a book. Yeah, I should create an indicator, but I could care less about having my name in a book. All right, so that is the basics of fast versus slow stochastics. RSI is, to me personally, it's much harder to read. I was mentioning that, Brandon Wendell. Brandon Wendell loves the RSI, and he uses it on price charts to look for what's called positive or negative divergences. So let me see if I can find some for you here. We'll go back and add in RSI. And what he's really looking for is when the indicator is saying one thing and the market is saying the opposite. That is in a nutshell what RSI is, or what what a positive or negative divergence is. Sorry, I had a brain fart for a second. So let me run through a couple of different stocks here and see if I see anything. We could all go back in the past and say, well, here's a positive or negative divergence. I don't like going back in the past because it's easy to say, oh, well, look, here's one. I would have taken that trade. Let's see if we can find something going here in the future. So you notice that right now on the SPY, looking at the S&P 500 ETF, we're making, right now, we've got the second high. As we speak this second, it was rising up and not quite the same high. Well, stochastics are also forming a lower high. So that's what it should be doing in a normal market. Let's go and see what else we got. How about... here we got trending down, so there's no negative divergence or positive divergence here. I'm going to flip through a whole bunch of charts just to see. You could make the argument right now that this is a sign of weakness. So the symbol we're looking at is Exelon. It's EXC. Look at the upper part of the chart first, right? You move up and you have a double top. It's coming right up to these all-time highs, right around $46, right? So you would argue that this security is showing a sign of strength. It's been rallying since late February, really aggressively from under $39 to over 46. We've sold off to 43, and now we're challenging those highs again. That looks bullish. But notice down at the bottom, I'll make this a little bigger so maybe it's easier to see. Let me see if I can bold these out for you as well. I know it's kind of hard to see. I'll make them as big as I can. All right, hopefully that helped a little bit. You'll notice that the RSI is not making a double top, right? Because back here, when it made this peak on April 19th, we'll just call it 420, April 19th and 20th, it was overbought on RSI. Now we're back up to those highs, and it's not overbought. It's actually at 61.99 or 61.91 right now. So that is what's considered a negative divergence. The indicator is saying that internally, the strengths of the moves are weaker than they were back here on the 20th. And the price chart is saying we're making the same high, right? So that's the challenge with this one. This actually is a potentially negative sign for the stock based off what you're seeing with RSI. Let's see, what did I saw someone else here? What about the fib retracement early waves? Eric, I'd have to do a whole different show on that one, buddy. And I'm definitely a fan of that, but that's a big can of worms there. Where was the one? Hecla, HL? Well, I don't know if I would say that this is I wouldn't call this a negative or positive divergence, right? What you're looking at here on HL is exactly what I expect to see. It's making, for this price chart, it's the highest price point we have. It's overbought right now and traversing sideways. If anything, this is kind of like a bullish flag formation, which is a very good positive sign, but I wouldn't call this a positive or negative divergence personally. That's just the way I would see it. I'm going to see if I can find any other better examples for you. If you think you have some. Here's another example. I mean, this is Edward Life Sciences. Same thing. You've got price coming up. Actually has a shooting star formation coming up into supply. Oh, man. Keep an eye on this one for tomorrow. And then the RSI is saying it's not even back to the highs. So this is a pretty, it's a decent negative divergence, right? It's not great, but we have a potential trade setup here based off the candle, based off supply. I haven't looked at volume at all, but this one looks, I'm actually going to make a note on Edward Life Sciences, EW, for myself for tomorrow. I like when I do these shows. Sometimes I find one. All right, ML, thank you. Oracle. Yes, perfect. This is a great example. Thank you, ML. You made my day. Notice that on the price of Oracle, it's been making higher highs pretty much since everything you see on this chart is higher highs. But notice Stochastics is now starting to it's getting weaker and weaker. So what that basically is telling you is that even though price looks strong, internally, the ratio of up moves versus down moves is actually showing some weakness. That's really what this is showing you on this price chart. So a great example of a negative divergence. A positive divergence, guys, would be exactly the opposite of this, where you have something that's trending down and it's showing weakness, and then the RSI is actually showing higher highs and getting stronger. It's just the opposite. Now, EW for a short. Alan, look at the price chart here. You've had the really big rally. If you put in your supply zone, you're looking somewhere in the range of right around $60. Or sorry, $60, $96. And we tiptoed above that today, and you have a shooting star formation on this one. I'd be looking at it as a break below the low of today's price action, which I'll get you the exact number in a second. 94.92. If it opens up above 94.92 tomorrow and then starts to trend down below it, then I think you have a great shorting opportunity here. You have a negative divergence, which it's okay, but it's the candle and the way that it's been trading recently. So I like it. All right. Everything Merlin incorporating RSI in my demo account. Keep it straight, supply and demand on high. Yeah. And I'm not, basically what I'm trying to get here is I don't think it should be something you guys say, I'm not going to use these things, they're garbage. I think they do add value. I think they can be great tools to assist you, like a crutch if you need, but you really should be looking at price action and making decisions based off that alone. Price action is the way to go at all times. All right, I didn't realize how late I was going. I wanted to get to this question from Ayal, who's actually one of my coworkers. He sent me this one. I said, you know what? I love when people send me questions because I can use them and incorporate them into the show. Is 40,000 a big supply level for Bitcoin? All right, I know some of you hate that I'm talking so much about Bitcoin, but who cares? I'm going to continue to talk about it because it's popular and timely. Here is the chart we drew. I think this is just absolutely a thing of beauty, really. It came all the way down to that exact number that was represented by this head and shoulders pattern. If you do a measuring object, that was just a beautiful thing right down to it. But let's get rid of all that. So what you got to ask yourself is, on the way down, was there anything formed on the daily that would make me think that 40,000 would be a supply level? And so if I put a line right here, I don't see anything that says 40,000 was a supply level. It really just bounced back and forth, right? It didn't. So to me, no. I don't see anything on there. And of course, we could go, let's say, to an hourly time frame and maybe find something on an hourly. Right? We bounced our head off 40,000 today. Yeah, I mean, you can see it's oscillated above and below it. I think the more important thing here isn't necessarily that 40,000 is backed by institutions that are trying to unload right now. I don't see any real clear evidence of that. What I do know is how big of a whole number, psychology number, 40,000 is. I mean, if you talk to David Warner, who likes to trade things in quarters, or we had Josh Lilquist on last week, who's using dimes, whole number psychology is very powerful stuff. And people are looking right now, just like my coworker Ayal, saying 40,000, man, it's going to have a challenge getting above that. And it's going to have a challenge getting above that simply because a lot of people are saying 40,000 is going to be a challenge for Bitcoin. So you're almost manifesting your own area of supply with Bitcoin and making these assumptions and whole number psychology. Now, of course, we could look at a whole bunch of other pieces here since we talked about stochastics and Bollinger Bands, or not Bollinger Bands, stochastics and RSI. RSI right now is saying it's way overbought. Right, so you have an overbought situation. It's trading right at $40,000. I'm sure that there were some people that felt that that would be the time to sell off on this thing and unload some of their position. We'll wait and see. Personally, I don't think it's going to be that big of a deal. But I also didn't see Bitcoin dropping, or the entire market dropping 50% in 2 weeks. I did see it selling off, and I did exit a large part of my portfolio, but I also bought back in at considerably higher levels. So this was definitely a nice drawdown in my account, but all in all, I think that you'll be looking at more upside move here. RSI on Bitcoin and RSI is negative divergence. Let's go add that one in, and I'll wrap things up here for today. So here's RSI, and I'll take stochastics off so we don't confuse everybody. Okay, and we'll go to the daily. And can you use this intraday? Yes, you can, of course. I wouldn't call this any form of divergence. I would call this clearly an oversold situation, which I don't think it takes any real thought process to understand that just by looking at the price chart. But you can get that confirmation with RSI. Was down below 30. RSI uses 30 and 70. Stochastics uses 20 and 80. So I have those mapped out accordingly here. But we were technically oversold here on Bitcoin. Comes right back down to this area of demand. It goes all the way back into January of this year. So no shock that we'd get a bounce here. The question is this downtrend done? It's been a pretty aggressive one for the past 2 weeks, but we'll see if that one's done. But I don't know. Really, I don't see any negative divergence here. I still see it. The RSI is trending lower and lower and lower and lower. So is Bitcoin. So at this point, no major signs there. Let's see. What else do I got? I'm talking about Bitcoin, Ethereum, and others. I call that head and shoulders on your show. Yep. There you go, Jerry. You called out, and I think it's funny because I think when you mentioned it, I go, yeah, I see it, but boy, I just don't see it getting down that far, at least not that fast. Right? I don't think anybody thought it would happen that quickly. So it took 3 days to get all the way down there. That was pretty impressive. All right, let me see what I got for tomorrow. I had an oil question from Ethan, so sorry, Ethan, if I didn't get to that oil question. I'll get to that one on tomorrow's show. Let me go to your economic calendar, which I had here. Oh, did I move it over? Well, I guess I didn't. Great. I just didn't change the date, guys. This is the economic calendar for tomorrow. This is your 5th or 24th of this should be the 25th. I'm all wrong on the days here. I love it. I could even go back through here since I have the technology now. We'll make this a 5. There you go. That's for the 25th. Really, the more important stuff is going to be your New Zealand dollar. So if anybody's trading the Kiwi down there, you've got 25 basis points is their official cash rate right now. They're expecting that to stay the same, so no real shockers there. For the U.S., you can see in the middle of their screen here, we've got quite a few important ones. The one that I'm really interested in is going to be this new home sales. We have Toll Brothers reporting earnings this week, which is going to be interesting. You have a lot of housing data. You can see here we've got the Case-Shiller Composite 20 Home Price Index as well as the HPI data. This number right here, this 12.6, is one of the sharpest spikes we've seen in decades for housing prices. So it's really heating up. We know that it has to do with the low rates on mortgages and people borrowing money, and of course paper profits that a lot of people are trying to capitalize on, leverage themselves right now and buy a home. Housing prices are through the roof, 12.6% gain. Your real estate market is almost beating the equity market. That's a sign of a bubble. What else do I got for you? We move on to your earnings calendar for tomorrow. Now, last week we saw actually most of the retailers posted pretty good numbers. We start to see more retailers tomorrow. You see we've got Nordstrom's reporting earnings, Urban Outfitters. We also have Intuit, and then AutoZone will be reporting before the market open. Everything else I just mentioned is after market close. So that's going to round it out for today. We got a ton of information there. Again, I saw a lot of new people, so if you are new, do me a favor, hit that subscribe button. If you like today's show, you learned something, give me a little thumbs up there. Hopefully you enjoyed it and got a little bit of, cannon fire for your RSI versus stochastics debate. Whichever you choose is up to you. If you choose none of them, great. What I would encourage you to do is not make the mistake that I think one of the viewers mentioned about a student in class. Jerry says, 7 years ago there was a guy walked in, his screen was covered in indicators. get that crap off your screen. You know, use them to help you, but you should be looking at just pure price, making your decisions off of price alone, and then add on those layers of confirmation if you want, but don't have them on there, because what ends up happening ultimately is you'll have more indicators on your chart. You start adding in somebody's recommendation to use CCI or ADX or MACD, and next thing you know, you got 5 or 6 indicators on there, and it becomes paralysis through analysis, and you end up not making trades or getting in bad trades because you're just trying to line all these indicators up. It's not going to work. You'll have days where one indicator says to buy, another one says to sell. What do? You trust price action, period. All right, that's going to do it for me. As I mentioned, I can't be to tomorrow's show. I was kind of looking forward to doing it, but we'll see you guys on Wednesday. If you have a show topic or guest or somebody that you want me to see, bring on, do me a favor. You can email me. Email's on the screen. It's TraderMerlin@gmail.com. Just let me know what you want me to talk about, who you want me to get on, and hopefully I'll get all ready for Wednesday's show, which I'll try to make it a fun one. That's going to do it for me, everybody. Hope you have a fantastic day. I'll see you next time. Cheers.